Are people currently worried about inflation? Yes. A new WalletHub survey found that 85% of Americans are concerned about inflation right now. Consumers were hit hard by rising prices in March, as inflation jumped to a level not seen in more than 40 years, according to data from the Bureau of Labor Statistics. The Consumer Price Index reached the highest point since December 1981 in March. Do consumers worry more about the price of gas and groceries or higher interest rates? Roughly 9 in 10 Americans are more worried about higher prices for gas and groceries than higher interest rates on their credit cards. Credit card interest is avoidable, and rates are usually high to begin with. For example, 132 million people think their credit card rates are too high already, according to a new WalletHub survey. On the other hand, you can't escape inflation in the prices of daily necessities. How do people feel about Fed rate hike decisions? People generally have a negative opinion on Fed rate hikes. According to a new WalletHub survey, 41% of people do not think it's good for the economy when the Fed raises rates. And 53% of people say that rate hikes are not good for their own wallet. Is there a difference between men's and women's opinions about Federal Reserve interest rate hikes? WalletHub's latest survey found that 72% more men than women think it is good for their wallets when the Federal Reserve raises interest rates. Men are also less likely than women to be stressed about their own credit card debt. What are investors' expectations for interest rate hikes in 2022? Markets indicate that rate hikes in May, June, and July are more likely than not. In May, for example, there is more than a 95% chance that a 50 basis point rate hike will occur. There also appears to be the possibility of 2 to 3 additional rate hikes later in the year, but a lot depends on how the economy responds. What are some things people can do to minimize the impact of Fed rate hikes on their credit card debt? People with credit scores of 700 or higher can minimize the impact of Fed rate hikes on their credit card debt by doing a balance transfer to a credit card that has a low introductory interest rate. Well-qualified applicants can get a 0% introductory APR for as long as 21 months from the best balance transfer credit cards. Alternatively, people with above average credit can use a low-interest personal loan to consolidate their credit card debt. People with lower credit scores can try making room in their budget for increased monthly debt payments to reduce the balance subject to higher rates after a Fed rate hike.